So actually, believe it or not, we try when we pass on a manager, which is like 98, 99% of the time, we try to pass and then also just provide at least a little bit of feedback if we can, to try to be helpful. Because we found that and not every GP will appreciate it, but I think it's a part of being a good participant in the ecosystem, particularly the emerging manager ecosystem. And if you want to be seen as an LP that can be trusted, that's helpful, and that young GPs feel comfortable going to, you want to have this reputation of being helpful. And so we try to do that, and it helps drive a lot of quality inbound deal flow to us. And in this part of the market, especially emerging managers, it is helpful to see a lot of the market because there's a high dispersion of returns, and you don't necessarily know all the firms, and you don't know the firms that are going to do well. So you don't want to close or narrow your pipeline. So being helpful, we think, has helped us be better at the front end of market coverage. And so it just comes down to being able to be quick, right? I think it's not scalable if you don't have one. I mean, we're fortunate we have a pretty sizable team, but we're all pretty experienced at this point. And even our analysts, will join us in meetings, and we'll quickly debrief. We'll quickly get the feedback points. Our intro meetings are just 30 minutes. If we know we're going to pass, we'll just quickly gather input from the team members that were on the call. Here are the things that they could probably improve on. Put it together in an email, send it out. Within like 45 minutes, we've met a manager, realized it's not a fit, provided feedback, and that's pretty efficient, quite frankly. And that you could probably scale.
Superclusters is the podcast to demystify the secrets, stories, and tactics behind the money that moves the venture capital world. Hello, everyone. Aakar Vachhani is one of the most sought-after LPs in the venture world. And as the managing partner at Fairview Capital Partners, and I want to say, at least at the time of this recording, a recent promotion as of January 2024. And Aakar, huge congratulations over here. We'll get into the weeds in the next hour, but as the managing partner at Fairview Capital Partners, a fund of funds investing to the best diverse and emerging managers in the venture capital world, something the most this is something that the VCs out there absolutely love. And I'm already stumbling already because I don't know if you can tell, my excitement for this is unparalleled. But Aakar first made his foray into the world of investing in venture capital funds back in 2006 in Cambridge Associates, before spending a short while at MK Capital and eventually going for the past 15 years, going on 16 years at Fairview Capital. He built out Fairview's West Coast practice, which has continued to expand to this day. And as a full-time dad of two and a loving husband and an investor in several venture funds, we have a lot to cover today. So without further ado, Aakar, welcome to the show.
Thank you, David. That was quite the intro. Appreciate it.
You have a prolific background and a resume. So we're going to have a lot of fun here. And I also want to thank the amazing Rick Zullo at Equal Ventures for introducing us. And without him, this episode either would have taken a much longer time, season 3, season 4, before it came out, or we may not have ever met. But being in the same world, I imagine we at some point will. Nevertheless, Rick fast forwarded that timeline for us. So there are many places we can start. I'd like to start from somewhere near the beginning. When we last chatted, Aakar, you shared something quite fascinating. As someone who grew up in a family of 10, you once told me you got accustomed to other people becoming parental figures in the household. And if you're willing, I'd love to start the conversation there. And I've only had, personally, one sibling my entire life, and I don't think my parents are having another child anytime soon, because both of us are well past all of us are well past our years. But if you could open the doors of the Vachhani household and share what was it like in your early days?
Yeah, I mean, I had I would say an atypical upbringing, I would say. And so the backstory is that my grandparents, my aunt, uncle, who's my dad's brother, they immigrated to the U.S. all in the late 70s, early 80s from India. But my dad and uncle were actually born in Burma, where my grandparents had lived. And they were forced out of the country in the early 1960s. There was a military coup, and anyone of Indian origin was forced out of the country, go back to India. And so they had lost everything. They had no money, no belongings, like nothing. Ultimately, and I'm kind of skipping a lot of the story here, but ultimately they made their way to the US. And so we all lived in a house together outside of Hartford, Connecticut. Eventually my sister and my two cousins were born. So that made 10 people. It wasn't a huge house. We all shared rooms, and all the adults worked different jobs. So we all, in addition to that, we also co-owned a convenience store. So different adults would be around at different times depending on work schedules. And us kids really got used to really like 6 parental figures if you include our grandparents. And at the time it was like the only thing we knew. So it was normal to us. So I guess when you and I were talking, you had asked this question along the lines of what are the long-term implications and impact of that kind of upbringing on someone? And it actually wasn't something I had really reflected on too much because I don't really have another experience to compare it to. But thinking about it a little more, I actually think there were probably a lot of positive characteristics that kind of forced on me in some ways, and really us, like all 4 of us. Some of the ones that come to mind are, one, this idea of being flexible and adapting to different leadership styles and having empathy for people in leadership roles, like realizing that there's a lot on everyone's plate. You could tell in our house, it was always somewhat chaotic. And usually people are just trying the best they can. And you have to respect that they're just trying to keep it together. Sometimes, now I can really appreciate that being a parent, and I wish my kids could sometimes see that, but they're a little too young. And then there's also this idea of just being part of a collective, right? And appreciating that, understanding the dynamics of a group, playing your role, going with the flow, being adaptable, finding ways to contribute. I mean, essentially like being a good team player. And I would say, I think these things are all probably things that have been important in my career because it's always the case, whether you're at school, whether you're in a work setting, and even our industry broadly, whether it's venture capital or the emerging manager community, being able to recognize and navigate the collective nature of things, I think is really, really, really helpful.
There are tons of things I want to double click on, more things than we probably have time to cover in this conversation. But there are 2 things that you mentioned that I thought was extraordinarily fascinating. 1, different leadership styles because you had effectively 6 parental figures. And then 2, the value of teamwork and being in the collective. Let's start with the first part of this, which is having different parental figures and naturally different leadership styles. Are there any examples of how you navigated some of those situations? Like if grandpa said something and then your mom or dad said something else, how do you balance the priorities of those things, so to speak? Like, oh, grandpa told me to wash the dishes and I'm making these up, but like mom told me to make my bed or whatever it is. Like, how did you balance all this?
That's a good question. I mean, yeah, everyone would, have, you'd be like growing up, like everyone would be telling you what to do, right? Like on the way out, mom saying this, aunt saying this, dad, told me to do this before he left. And now my grandma's telling me to put that away. So it was like, you're just getting like orders from a bunch of people in some ways. And I really respected everyone. I think that was something that I learned. So honestly, I was like a good kid, probably too good. And I would just try to do everything that I was responsible for doing. And I was also the oldest child. So, the younger kids were, like they were going to take after me. And sometimes like there were no adults home. And so I was the one responsible for taking care of the younger kids and my sister sometimes. And so I was forced into like a semi leadership role early in my life. And so I think it's a hard question to answer because I kind of fell in line with the adults at some point.
I'm curious because I'm also the elder of 2, and you're the elder of many more. But there is a great proclivity to, and at least in my case, becoming the 3rd parent, in your case, becoming the 7th parent, so to speak. How, like when you did choose to take on leadership roles, which leadership style did you like to lean towards when you became the leader among the kids?
Oh, it was always like trying to be the type of leader that would get buy-in first, because I would want to try to get everyone not to like take orders from me, but to try to be on my side, if you know what I mean, to get them to understand, hey, if we don't clean up, we're not going to get dessert, or, just getting them on board with whatever plan it was. so that we wouldn't all get in trouble, and then that we could all be happy. Like that's definitely my style.
And when you speak of collective, obviously you're like, hey, if we don't clean up, we don't get dessert. It sounds like there's a lot of we in all of this, right? Like going to the second part of this question, which is the collective. It sounds like you were all in it together. No one was going to stand out and point the fingers at everyone else and be like, hey, I did my stuff. No one else did their stuff. That's why I should be rewarded.
It didn't matter. Yeah. It was. Right? It's like there's 4 kids, so it was so much more efficient for the parents and grandparents to just punish us all at the same time or reward us at the same time. There wasn't time to do like 4 sets of punishments and rewards. So it was like, if somebody got in trouble, we pretty much all got in trouble. If we all got rewarded for something, or if one person got rewarded for something, we were all going to benefit from that. So yeah, definitely like a collective.
I love to hear it. I was selfish in my childhood of like, I did it, but my brother didn't do it. And over time, we realized like, no matter how often my brother and myself pointed fingers at each other, we'd be punished equally. We'd be rewarded equally as well. And so over time, we ended up like, you know what, we're in this together. We're in the same boat here. Let's row it together.
Yeah, and it's just like it's magnified when it's four kids, and then you learn quicker when it's 4 kids too.
That's true. Fast forwarding a little bit. This might be, I apologize for the whiplash if there's any whiplash to this question. But fast forwarding 2005, right? You are paying $400 per month of rent, living in an old house with 5 other guys. So speaking of sharing rooms, this is something that thematically has carried across even till your post-college years. Hell, your parents are asking you, like, Aakar, come home, back to Connecticut, start a life working in insurance. I mean, to me, it's the classic scene of, where the protagonist has this flashback moment and at the beginning of the movie. And that when you described it to me last, I was like, that's exactly like that. For you, I'm curious, what was the self-talk you were going through? Because you were living in an old house crammed with the 5 other guys. And at the same time, your parents were asking you to come back home. And there's multiple pressures from multiple directions plus rent, right? How did you manage that, and what were you telling yourself?
Okay, so the story here is I'm going to go back a little farther. So it was senior year of college. I wasn't doing so well on the recruiting front. I had gotten an internship at a startup, which eventually I took on as a part-time job during school during my senior year, and I actually liked it a lot. It was an early fintech SaaS company doing customer identity verification software for banks. It was a small team. I learned a lot about things I wouldn't have otherwise, like software development, sales, business strategy, just really great exposure for somebody early in their career. But it paid like around minimum wage, and there were no benefits, no health insurance, and they were gearing up for an exit, so there wasn't a full-time job there anyways. And so around that time, I was becoming more familiar with venture, and I loved the idea of combining my love for tech with investing, which I was also learning about at school. And so I applied to a bunch of private equity and venture capital firms. Of course, it's like impossible to get in. And back then the industry was way smaller. So I never got an offer. But then I came across Cambridge Associates, which is an investment consultant in our industry, for a role working with venture capital and private equity data. And I was really impressed with the firm. Thought it would be a great way to learn more about the industry, get my foot in the door. And even there, like I applied to an internship there, figuring, let me just get in any way I can. And I was rejected. I applied for a full-time role with Cambridge later during recruiting. Didn't get an offer. And then, back then they would actually mail you a physical rejection letter. And so I got that. I had 2 rejection letters from Cambridge, and I remember pinning them to my desk. And I know it's kind of cliche, but I really, really wanted that role. And if nothing else, I figured I could use that rejection as motivation. And so at some point along the line too, I happened to get an interview with an insurance company in Hartford. And it was for an underwriting role, something I really wasn't interested in, but I needed a job. And so I went down for the interview, didn't hear back, and I thought it had gone okay, but I didn't hear back, and I kind of assumed that I didn't get it either. And then for some reason, near graduation, Cambridge opened up hiring for that same role I was interested in that I got rejected from essentially twice. And so I guess the spot had opened up. And so I applied a 3rd time. And this time I went through the 3 rounds of interviews, getting close to graduation. I ended up getting the job. And right at the same time, I got an offer letter in the mail from that insurance company, which I had written off. So now I had 2 options and they were either to take this insurance job, and the Cambridge job was in Boston, by the way. So there was an insurance job in Connecticut, which actually paid more. I would be able to live at home, save a bunch of money, or I could take a lower paying job in Boston, ultimately live in that 100-year-old house with 5 other guys, save no money. And so for my parents, the choice was crystal clear, no brainer, move back home, work in insurance, save a bunch of money. But for me, I really, really wanted that Cambridge job, and I really wanted to learn about venture. So at that point, they were calling me. I had already taken the job, post-graduation, moved in. They weren't happy about it, but, we would talk on the phone all the time, and then they, would try to convince me to move back home, even after I'd moved into the house. And I think today they're okay with that decision, but it definitely took them a long time to come around. And so I guess the lesson through all that was, don't be afraid to take a chance on yourself and follow your interests and your passion. And it's something you probably hear often, but it's because it's really true. Especially in this industry, I think it's hard to get into and succeed. And it's even harder to make the sacrifices you might have to make, particularly if you have no money and you're early in your career. But I think it's worth taking a shot if you're really passionate about it.
Oh my God. First of all, that's a great story. Second of all, I have so many follow-up questions. One of which I like. I love the anecdote where you got 2 rejections from Cambridge and you decided to pin them on your wall. You're like, I'm going to use this as motivation. And that reminds me a lot of the story where the Reddit founders were talking to this Yahoo executive, and the Yahoo executive is like, hey, we're not going to buy your company because you guys are a rounding error. And ever since then, Alexis Ohanian just literally stapled you are a rounding error on the Reddit office wall, and everyone used that as motivation to prove that Reddit was not a rounding error. And this story harkens back to that. I'm actually really curious. You mentioned that you got rejected twice, and then you applied again for the 3rd time. You got through 3 rounds of interviews, and I know we took a couple leaps of faith, transgressing the timeline, so to speak.
Yeah.
What was that conversation like? Did they know you had applied 2 times before? Did you mention that I applied twice before and this is why I'm still really excited to join Cambridge? Or what was that, if you remember? I mean, obviously this is many, many years ago, but if you remember, what was that like?
I do remember. And I think it was, in part, I was really, I had those letters pinned on my desk. I was motivated. And I was like, this is my last, I knew it was probably my last chance, right? 3rd time, there's no way, 4th time they're even going to look at me. But I went in with an attitude of I have nothing to lose. And at that age, you're young, you don't have a lot of interview experience. You're probably me, and I was nervous during those interviews, and the pressure could really get to you. But kind of use the letters as motivation to, in a way that I, didn't want it to weigh on me. I wanted to just kind of be loose and just, have nothing to lose. And I remember one of the things I asked is, one of the things I wanted to make sure that came across was I was really passionate about this role. And I don't think that had probably come across when I previously had applied. And so, I made it clear, I really want this job. I've interviewed, 3-4 times at this point. I said this to them, and I said, I interviewed 3 or 4 times. Is there anything in my resume that you think, would not qualify me for this job? And, just asking hard questions on them that maybe I wouldn't have otherwise if I wasn't so motivated. So it was definitely a different tactic. And I think, having those letters there probably influenced kind of how I prepared for it.
Fast forwarding a little bit to another part of that anecdote. You are situationally, you've accepted your job at Cambridge. You've chosen your interest over more salary, as well as being closer to home. And you were living with 5 other guys. And I find a lot of this story, I find your environment really important. I mean, what is that line? You're the average of the 5 people you hang out with most. Mm-hmm. What was the environment with the 5 other guys? I assume these were college friends.
Yeah.
Right. What was the environment like? Was everyone chasing their interests in that household, or were people chasing just different job opportunities? Did you feel pressure from any, one of your housemates that, oh my God, they decided to work at Wall Street or whatever it is? But what was it like?
It was fun. It was interesting. We had a variety of personalities. We had a variety of different careers that people were pursuing. So it was a diverse group of guys. And everyone was early in their careers. Everyone had just graduated. It was, my old roommate from college and then a bunch of other friends. And I think we all we're going through this experience in life at the same time, living in Boston. It was all new. So it was great to have other people around actually to, commiserate about the things that, you learn about early in your career, the challenges you're having, to be able to lean on each other, also to be able to unwind together and have fun. So I really became close with all those guys. And, I look back on it pretty fondly, but, it wasn't like a luxurious living or anything like that. I mean, it was pretty rough living conditions in a lot of ways, but it was fun.
It seemed to be quite formative in your early career. At some point, I mean, you're living in a 100-year-old home. Like my brain is thinking like we should just like open it up every Saturdays as a museum and have people pay an entrance fee of like $20 to check out this museum of a house.
It's like, I mean, if you've been to Boston, there's a lot of old houses, but this was an old house that a lot of them have been redone. This house, was kind of showing its age in a lot of ways, put it that way.
Okay, switching gears a little bit over here. One of the things I found really fascinating, and Rick, who introduced us, seeded this idea in my mind and this question eventually in my mind as well, which is, I mean, you've been, and this extends across not just Equal Ventures, but a lot more, right? But you've been a big supporter of Equal Ventures since its before Common Era days, right? BCE days. And for like our mutual friend, Rick, told me that you've gone above and beyond, and I'm quoting this, like, not just helping them with the fund, but showing support during moments that they actually really needed it. But also being a huge help with things like the emerging manager circle and all that kind of stuff, which definitely falls out of the scope for the typical LP out there in an emerging manager. And plus, let's be honest, you have a big portfolio as well. And so I'm curious, what compels you to go that extra mile, and how do you do so across a portfolio of managers?
Yeah, great question. Fairview is a really active investor in emerging firms, as you've indicated. We've been doing this for 30 years. We've done over 50 first-time funds at this point, and we almost always take a active role, certainly more active than most LPs. And there's several reasons why. One is a simple reason, and I think that's because we're a fund of funds, and we make a GP commitment to each of our funds of funds, alongside our LPs. And therefore, when we're committing to managers, we're investing our own capital into each investment. And that means there's a really strong financial incentive to make sure we do everything we can to help every single one of our managers succeed. So it's a really great alignment of interests, which sometimes is missing from a lot of LP roles, and I think is, conversely, a really strong case for the fund of funds model. But, beyond that, I think, another big reason is just that we really care about the investments we make and the people we back. I mean, again, as a fund of funds, we work really hard to raise every dollar we invest. And because of our approach, which maybe we'll talk about later, but we see like hundreds, thousands of managers. We're investing in, 1% to 2% of the funds we see. It takes a lot of work to get there. And then when we're investing, we have a lot of conviction. We're all in, betting on a team, especially when investing in a new firm. And it's kind of like a venture capitalist backing an early stage founder. So because of that dynamic, we become really invested in our manager's success. And for Fairview, with the 30-year history, I think it's also a little bit easier for us to go above and beyond because we have this unfair advantage of having access to the best practices from not only some of the most tenured, best-in-class firms in the world, and we're on a lot of those advisory boards as well, but also just 30 years of experience helping emerging managers deal with issues that typically affect them. And that's really valuable insight that we can bring to our GPs. So why would we not be active in helping, right? So I think that's like good advice for young LPs and LPs in general. Like, try to be helpful to your GPs, especially emerging managers. There's probably some learning, some best practices, some insights that you can share. There's probably some introductions you can make that can be helpful. And it makes for a much more meaningful relationship if you do those things. You become closer with the GPs. You actually will learn a lot more too as a result of that. And over time, as you get more reps, being closer to firms, I think you become a better investor. And I mean, at the end of the day, if all you're doing in your role is just sitting there and picking funds and moving on, I think the value in that as you build your career is getting lower and lower as the industry becomes more mainstream. So as an active LP, you can really better position yourself for long-term success, even if it means putting in extra work, going the extra mile. And so I think that's really important for young LPs to build that as part of their skill set. And then the other part of your question was, how do we do that at scale across a portfolio of, at this point, hundreds of managers we've backed over the years? It's really just, one, leaning on your team. And we all work really hard and put in the time, and everyone's got different experience and expertise. And, our co-founders literally have been doing this for over 30 years. Knowing when to lean on your partners and your team, and, just being efficient about providing feedback, knowing exactly like the points where a manager can use help, and then putting it together and getting it to them like that. Just building those reps, I think, really makes a big difference.
To help some people with their timelines, and just to make this a little bit more concrete, you mentioned going all in, you mentioned being very helpful, you mentioned being a value add, scaling value add effectively, and just like leaning in and being around. What does that look like in practice?
Yeah, it can really vary from firm to firm, right? If it's a young firm that's just getting started, I mean, you gave the example of Equal. In that situation, they may need help in, getting feedback on their materials, and they might not even ask for it sometimes, right? But you've seen a lot of first-time fun pitch decks. What will resonate with LPs and what won't. So there's probably constructive feedback you could provide. Diligence materials, like, here are the things that we needed to get comfortable. These are probably things that other LPs are going to need too. So maybe consider, putting these things in your data room that were helpful to us. So it's more concrete things like that. It's certainly introductions. Every GP, when they're getting started, can use introduction to LPs. And so if you have conviction in a manager, you're going to be committing, or you've already committed. I think other LPs would respect that. And it's much more helpful and respectful to make an introduction to a GP you've already got conviction in than just making introductions to LPs, just to try to help them out. It goes a lot farther. So we're really careful. We generally don't introduce other LPs to GPs unless we're also investing. And those are probably like some of the main examples I could think of.
I think there's a world of being proactive versus reactive. Like you said in your example, some people might not even know they have questions in their pitch deck. They might not come to you for questions or getting feedback on their pitch deck. But it sounds like, and correct if I'm wrong here, that when you see a pitch deck and they send it to you and you notice these glaring mistakes or red flags or orange flags, you proactively go like, one, would you be interested in feedback? Two, if you are interested in feedback, here are things that I've noticed that you might want to consider adjusting.
Exactly. And I think good GPs should, well, I think, and maybe this is advice for GPs, but you should ask, for feedback from early pitches that you make, whether or not the LPs are investing or not, because you'll gather a lot of valuable information from that can help you improve and hone your pitch. So that can be really important.
That's fair. But also I imagine, let's be honest, Aakar, you see tons of pitches, if not hundreds, if not thousands of pitches. You can't give feedback to everyone. Is there a format that people can ask? And this might end up being opening the floodgates here, so I apologize. People may no longer be able to use this, but are there ways in the past where you've received a pitch, and even if you're not investing, they've asked for feedback, that you've been receptive to giving feedback?
So actually, believe it or not, we try, when we pass on a manager, which is like 98, 99% of the time, we try to pass and then also just provide at least a little bit of feedback if we can, to try to be helpful, because we found that and not every GP will appreciate it, but I think it's a part of being a good participant in the ecosystem, particularly the emerging manager ecosystem. And if you want to be seen as an LP that can be trusted, that's helpful, and that young GPs feel comfortable going to, you want to have this reputation of being helpful. And so we try to do that, and it helps drive a lot of quality inbound deal flow to us. And in this part of the market, especially emerging managers, it is helpful to see a lot of the market because there's a high dispersion of returns and you don't necessarily know all the firms and you don't know the firms that are going to do well. So you don't want to close or narrow your pipeline. So being helpful, we think, has helped us be better at the front end of market coverage. And so it just comes down to being able to be quick, right? I think it's not scalable if you don't have one. I mean, we're fortunate we have a pretty sizable team, but we're all pretty experienced at this point. And even our analysts, will join us in meetings and, we'll quickly debrief. We'll quickly get the feedback points. Our intro meetings are just 30 minutes. If we know we're going to pass, we'll just quickly gather input from the team members that were on the call. Here are the things that they could probably improve on, put it together in email, send it out. Within like 45 minutes, we've met a manager, realized it's not a fit, provided feedback. And that's pretty efficient, quite frankly. And that you could probably scale.
What this reminds me of, and let me know if this is a good quote to describe the practices in which you have at Fairview. Blake Robbins at Ludlow Ventures once wrote this blog post, and I think he was quoting someone else, but I forget the attribution in which he had, but I just remember reading it on his blog post probably like 10 plus years ago or something like that, where he said, the greatest compliment an investor can get is to get deal flow from someone they passed on. And it sounds to be inextricably true for you as well. You give feedback in ways you're intentional about the way you communicate with investors in a way that even if you pass on them, they really enjoyed the company and the lessons and the insights in which they've gained. And they're like, hey, you know what? I actually have another fund who is
Absolutely.
Probably up your lane.
Yep. I will tell you, like, every day I'll get an email from a GP that we passed on that says, hey, you should, have you looked at so-and-so? Would you like an introduction? It literally happens almost every day.
Do you, out of curiosity, do you measure your virality coefficient, like the number of GPs who like intro you to another GP that's not already in your pipeline?
That's a good point. We do look at, I don't remember off the top of my head, but there is a lot of our inbound deal flow is a lot of referrals. Okay. It ends up being probably the highest proportion of opportunities. Yeah.
I mean, you guys have also been in the industry, I want to say since 1994, right?
Yeah.
So this is your 30-year anniversary, actually.
It is.
And so I imagine you've built this, you've accumulated this network, which kind of compounds on itself.
Mm-hmm. Yeah.
One of the other things you mentioned, and I kind of want to go back, which is you say you usually can find out if you want to pass on a manager within the first 30 minutes. What do you typically look for, or what are typical red flags in which you look for that help you decide that, oh, we're passing on this manager?
Yeah, I mean, there are certain things that are pretty basic for us, right? We initially will look at, is there a team? We have a really strong preference for teams. Does this team have a track record? So we do a lot of first-time funds, but we don't invest in people that are new to investing. So it's really important for us to have seen some, ideally institutional, track record, but not always. But there has to be some sort of track record indication that, this team has the ability to invest institutional capital. 50 million is kind of the minimum size for us, given our scale today. So if it's a really small fund, we know it's not going to be a fit. It quickly turns into like a relationship building call, and there's really not a lot of pressure. So we can, just be, it's just more of a conversation, getting to know somebody, and, you learn a little more, you learn a little bit different elements about a firm, and you can provide feedback, without a lot of friction there. And then other things, I mean, the strategy has to align with where we see the market, portfolio construction. We have things that we have preferences for, whether it's the size of the portfolio, ownership, things like that. And so there may be a lot of things early upfront that might screen somebody out. But then if it does pass that screen, then it becomes, a whole different level of diligence, which, we could talk about later.
You mentioned you would pass on one of the things you pass on if someone is new to investing. And I want to put that term under a microscope, just because I find new to be a relative term, but also amorphous, nebulous in ways. How do you define new to investing? Like in your mind, is there a sample size their track record must be at before they're no longer new?
I think so. There's a whole range, right?
Yeah.
The most cleanest, easiest thing to underwrite is a team of people that have worked together at a firm that's an institutional firm, that's tenured. They've got an attributable track record. They spin out, and it's easy. And the other end of the spectrum, you have people that have never worked at an institutional firm before, trying to get into the industry. Maybe they've been an operator and they've been successful. Maybe they've angel invested. Maybe they've been a scout. And these are like the early beginnings of building a venture track record. And in those situations, ideally they're teaming up with somebody who has institutional experience. But again, not always. We may see somebody that's really talented, has great deal flow, and that we have conviction in. But maybe they've only done, a handful of deals. But I think there at least has to be something that we can look at. So if it's an operator, have they been successful? Ideally they've done it multiple times. Or if it's somebody who's been angel investing or scout investing, ideally there's got to be at least 4, 5, 6 deals that we could look at and reference and talk to founders, to get a real sense of somebody's investing style and capabilities. So that's like the earliest, that we would go where there's a little bit of traction that we can maybe start digging into. So that's kind of the range.
If I were to just spell that out just a little bit, because you said the lowest on the range is probably 4 or 5 deals they've done as an angel already. Is that 4 or 5 deals in aggregate, or is it 4 or 5 deals, so to speak, on thesis?
Ideally on thesis. If they're not relevant, I think that makes it a lot harder, right, to get comfortable.
Yeah. Now, if they're doing a climate tech fund and every single investment they've made has been deep tech or space tech or whatever it is.
Exactly. Yeah. I mean, that's probably not an immediate fit for us. If we really like somebody, we may wait, right? In that case, we're not going to be the first LP. We're not going to be the first close. We may watch them and come in at the tail end of the fundraise if they've, raised some capital, started to invest, demonstrated the strategy a little bit. That might be something that get us comfortable, but yeah, right off the bat, that's probably hard.
I want to talk about building out Fairview's West Coast practice. You made I believe a one-way trip out here, if not maybe multiple trips and all that. But nevertheless, you decided to come out here to the Bay Area, where you and I are both now reside, instead of staying in Connecticut, where the majority of the team at the time, and I believe probably still is, based. Could you walk me through, what was it like building out an office in SF, why that made sense to the partnership? Obviously, tons of funds and deals were getting done here, but what was the conviction the team needed to have for you to build out a practice out here?
Yeah, so I moved to San Francisco in 2016. This was after I started at Fairview in 2008. I had left to go to business school, came back to Fairview. And when I came back from business school, I really, one of the things I really loved about Fairview was the team, right? I had a lot of trust in everybody. I love the entrepreneurial culture, love the culture in general. And I love the parts of the market we were investing in. And I really wanted to build my career there. Concurrently, the industry was shifting, right? So we had seen an explosion of emerging managers. The cost of start a company had come down. Seed stage investing was becoming a thing. It lowered the barriers to entry into venture. And Fairview, with an emerging manager practice, historically never felt like it was missing anything, because 15 years ago, all the best new firms were just spin outs of top tier firms who we had relationships with. And in general, the market was smaller. So kind of saw an emergence of a need probably for a West Coast presence in a way that we didn't before. And it was pretty clear. I think Fairview was thinking about it anyways, but I was in a great spot because I knew the team. I was young, early in my career, still, didn't have kids, so pretty flexible. And so when I came back from business school, had that conversation about ultimately moving out to San Francisco, and everyone was on board. And so I kind of reintegrated with the team for, I think it was about a year and a half, and then moved out to San Francisco in 2016. And so this was before COVID. This was before Zoom meetings. And before distributed teams were really normal, virtual offices were not a thing, right? So it was not an easy thing to do. And at Fairview, we're big believers that this work requires the best thinking from a group of smart people with different perspectives, really to come together to make the best decisions. That's true for investing. That's also, I think, true for things like firm strategy, new product development, et cetera. And so that's hard to do if you don't have a common culture as a baseline, if you don't have a feel for each other and for how everyone comes at the world. And to have that, there's no real substitute for spending time together in person. And I think that's the biggest part of the scaffolding, if you will. Having spent several years with the team, I think it was like 5 or 6 years at the time before I moved out here, building those relationships, understanding how everyone works, building a really high degree of trust in each other. That's what made it seamless. And then the next big thing was like after I moved out here, communication, right? How do we keep that up? I was 3,000 miles away. How do you keep up all that we had built? And that just has required a lot of deliberate effort. I talk to my team literally every day. We're collaborative in nature anyway, so we do a lot of group work, which helps. But I make it a point to always be in communication with the team, and we make sure to see each other in person a lot too. But it's worked out really well. It's not something you can take a shortcut to. You just have to put in the time and energy to make it work. Otherwise, you risk losing the benefits of having a broader geographic scope as a team. And we've seen it with other firms where, it can even become detrimental if you don't do it right.
You spent 5 or 6 years building relationships out here in the Bay Area before you decide, like, hey, let's move out here in 2016 and make sure that transition's seamless. Mm-hmm. How did you go around like intentionally building those relationships? Did you come here a week per quarter meeting managers, and every time you were here meeting 10 managers? Like, how did it work?
Yeah, I mean, we were fortunate because I think at least more than half of our relationships are already based on the West Coast, vast majority in the Bay Area. So we already had a great network here. Okay. And we would spend a lot of time here for annual meetings, for diligence, et cetera. So I was already coming out fairly often, as was the rest of the team. So we'd spend a lot of time here. For me, it was important to spend time with the people in our network that we really trusted and, had longstanding relationships with that would, give us a better lay of the land, and strategy around, where to be and who to spend time with and what events to go to and, what are the benefits of being involved with this organization or that organization. And so just like information collecting at a different level. And we started doing that definitely in like the couple of years that led up to when I ultimately moved out here.
And on the flip side of that question is, I mean, it sounds like the team is more distributed than when you first started at Fairview. Obviously, we're in the Zoom era. You did mention that catching up with the team in person was very vital to preserving the culture. Mm-hmm. How do you decide the cadence in which you continue to meet in person? What are things that you do to preserve the culture, even though you're on opposite sides of the coast?
Just spending a lot of time with each other, so I will go back to Connecticut at least, 4 or 5 times a year. And luckily my team, like I said, a lot of our relationships are out here. So most of the investment team comes out to the West Coast fairly often. And so we have that. And then, there's obviously virtual meetings. And again, like having built these relationships over a long period of time, I already know everybody really well. And so we kind of have a really great baseline. It does make it harder, to be honest, for newer people. And so I try to make it a point to really spend more time with like the analysts on our team and get to know them. And so when I go back to Connecticut, I'll spend extra time, like do extra lunches and things like that, just to really try to build that relationship. But it just takes deliberate effort at the end of the day. There's really not a lot of shortcuts.
Let's make this a little bit more concrete. Let's hypothetically say I, David, have joined the Fairview team. I'm on Aakar, your team, in terms of venture and all that kind of stuff. As I'm just beginning in your team, like what are ways in which I would be onboarded that I would better understand the Fairview culture? Is there like a rule book? Is there a playbook? Do you set up one-on-ones weekly? Like, how does that work?
Yeah, we do. I mean, we have like a mini onboarding, process, if you will. One of my partners does he's got essentially a curriculum of like private equity 101, venture 101, fund of funds investing 101, all this data and insight we've accumulated over the years. And then we've done a pretty good job of putting together, codifying our culture. We've got a bunch of internal documents, that talk about, our culture, and what it means to be an employee at Fairview and part of the Fairview team. So those things are important to share, but there's really no shortcut to kind of instilling all that into a young professional at Fairview, other than giving them a lot of reps. So, we pretty quickly give our younger professionals exposure to meeting with managers. Pretty much from day one, we'll have them in meetings. And I love actually having young people in these meetings, because they have different perspectives. They look at the world from a pretty fresh lens. And, they will provide, usually when we have a meeting, like the first person we'll ask for feedback is the youngest person on the team. And just to get their thoughts and how they, learn about how they think. And that way they're not biased by what we think and what we say either. So just, and that gets them comfortable, being open, sharing their feedback. That's our culture. They're not going to be judged by, what they think. And then we'll also include them in partner meetings when, they're involved in an investment that we're looking at. They even, like we had our investment committee meeting yesterday, one of our analysts had, co-worked on a opportunity we were looking at that was presented. They also voted, right? I mean, so they also, take part in the decision-making process in the investments that they're involved in. So that, all those things really help.
One thing I'm actually really curious to kind of like actually jumping a little faster on our timeline, so to speak, at least in terms of the questions. You mentioned that the analyst also gets like a voting right, so to speak. And correct me if I'm wrong here, because I may have read this somewhere and you can only trust so much you can read online. But the team needs to come to a unanimous decision before they invest in the manager. Is that accurate?
That is accurate.
Okay.
That is accurate. Yeah.
And if that is, like, what are the mechanics of that, right? Like, how do you, like, everyone has different opinions. There's a diversity of opinions at the table always, right?
Mm-hmm, mm-hmm.
And if you have people, like, let's say you're championing a deal, Aakar, like, how do you convince the rest of the team, or do you convince the rest of the team that this is a good manager to be betting on?
Yeah. It's technically unanimous by the requirement of, it's each partner has to agree to the deal, but in practice, actually, everybody who's on our investment committee meetings, that could include, an analyst if they worked on a deal, has to agree for us to move forward. And I think unanimity is great, because that means that we all have ownership in every investment decision and relationship that Fairview has. And it also means that everyone's perspective and best thinking comes to bear on every investment that we make, which is really powerful, especially for long-term fund investing.
Yeah.
But the key, I think, is being aware that it could lead to groupthink, which could be very dangerous, right? You don't want to end up with a bunch of average, non-controversial investments. That's totally incompatible with what we do, right? Like, we need to generate outsized returns to exist. And I think that's why a lot of firms don't require unanimity, or they may have like structures where partners can make their own investments. A lot of VCs, if you talk to them, will tell you that their best deals were ones that had a barbell sentiment, where some people loved the deal, other people hated it, and there was no in between.
Yeah.
So we don't want to lose that element of what makes this industry special. Yet you don't want to end up with a bunch of silos. So the way we do it really comes down to culture. We totally trust and respect each other. We're open. Again, technically, I or any of the other partners or anybody at the investment committee meetings has a veto. But if someone really feels strongly about an investment, earlier in the process, and they'll know the concerns that other people on the team have. It's not like, we've never heard about a deal and then you go to the investment committee meeting and here it is, vote yes or no. It's a collaborative process, multiple stages. Everyone has opportunities to weigh in along the way. So, if you're somebody on the team, you've got a lot of conviction in investment, you're going to know what the concerns are that other people on the team have. Mm-hmm. And if that person's put in the work, they're passionate about it, and we're comfortable enough, I think we would trust that judgment. And, like we would respect that they have the ability and expertise to see something that maybe, I don't. And so you also need low ego across the team so you can be all in at that point. And then once it's a Fairview deal, we all own it, which I think is also, again, goes back to my point of having ownership in every investment.
So I know there are some venture firms out there where if you come in as an investing team member, for the first year, you're not allowed to make investment decisions because the whole goal of that first year is for you to understand how the team works and how the team makes decisions. And only after the first year, no matter how senior you are, then you get to start making investment decisions. In a way, like let's say when the analyst comes in, they have a voting right, so to speak. Is there a similar sort of practice where like the first 3 to 6 months, is there an onboarding period of them understanding everyone else before they get the voting right? Or do they get the voting right from month 2, so to speak?
There's no official time frame, but in practice, it probably takes several months to get up to speed, right?
Yeah.
Before somebody gets an opportunity to work on a deal, and then is involved in the investment committee meeting. So I think that just happens naturally, to be honest, for us.
Okay. I mean, 30 years of culture, like it what works, and some things might be unspoken, so to speak, but everyone understands how it works. And I don't know, I find it to be. The purpose of this conversation is also for me to be a fly on the wall, if you couldn't tell from my line of questioning so far. Okay. I'm actually, so one thing that I've, in the process of doing homework for this conversation, which I found to be really, really interesting, is that you did a presentation with Illinois SERS, and for the untrained ear, SERS is State University's retirement system for Illinois. And you did a presentation for them. And in that presentation, you said something, at least I promised to myself I'd pick up the gingerbread breadcrumb trail for, which is you said you look for VC fund managers who are, and I quote, thesis driven, but also not too focused that you limit your opportunity set relative to other firms. And my question here is, I want to kind of put that line under a microscope. How do you, as an LP, walk through the tightrope of trying to understand whether a thesis is focused enough to not limit the opportunity, but set broad enough where it can capture the greatest companies of that vintage firm, and so that seed stage firm can do a 5x net, or like a Series A firm can do a 3x net?
Yeah, you really did your homework. So SERS, SERS is an amazing partner of ours. They're a sole LP in the Lincoln Fund Series, which is a great emerging manager program. Great history now, 10 years, $275 million. And so, they've been great partners. And I think that comment, around being not too focused was coming from a place of, like one of the consequences of the high rate of new venture firm formation we've seen in recent years is that it's becoming a crowded market. And in an effort to stand out and appear more differentiated, I think a lot of new managers have created strategies that are way too narrow. That can mean things like, an exclusive focus on a very specific technology or a niche market vertical, or maybe it's an emerging or smaller geography, or maybe it's investing along or with a network specific to alumni of a certain company or a certain university, things like that. It may be appealing to maybe some strategic investors, but in general, we find that you can really limit your adaptability if market conditions change. You have a higher risk profile because you're concentrating exposure into whatever your focus is. And then the third, I think, is, and maybe this is the most important, is that you just have a limited investable universe. In venture, given the power law dynamics, we don't think you really want to restrict your ability to invest in a generational company. Mm-hmm. And so I guess your question is like, how do you know if a strategy is too focused? I think it's hard to answer concretely. I think it's one of these things that you just know based on your experience. Mm-hmm. And I'm not saying we bias ourselves. We will still meet with every firm and evaluate it on its merits and hear out the story. But usually after digging in a little, we can, again, based on our experience, make a pretty decent judgment on if a strategy is too narrow or not. Yeah. And we'll do specialists in larger categories. So if it's and even if it's a new category, one that we think could become larger. So we've done things like, a SaaS focused fund 20 years ago before, it was a thing. Mm-hmm. We've done consumer focused funds, we've done fintech, et cetera. But we also really like generalists too that have thesis driven approaches. You mentioned equal, and that's a good example. Yeah, we think that approach makes for really well-rounded investors with a broader perspective. And the good ones will have a prepared mind so that they really know the businesses and the markets that they're going after to the point where they can connect with founders and actually help them in a way that a focus firm can. So you have the benefits of being focused, but you avoid some of the challenges of being too focused, right?
The kind of inspiration behind this question is, one, obviously what you shared on Illinois SIRS, the presentation you had, but also I think about certain firms from back in the day, like let's say 2012 Eniac Ventures, who decided to focus only on mobile. Like we barely had, like the early versions of iPhone were not good, let's be honest, right? But they decided we're going to go all in on mobile, and this was back in 2012, and obviously they proved to be right in 2024, where everything's on mobile these days. In my mind, and obviously I had yet to be a professional back in 2012. I think I was still going through the early throes of high school. But to me, that seems like a very focused, narrow thesis. And if we were to rewind back to 2012, would that be a kind of investment that Fairview would end up passing on?
Well, no. So we're actually we're actually LPs in Eniac. So the answer is no. That's an example of a category and a team where we felt like was big enough that they wouldn't artificially, constrain their opportunity set. And since then, essentially everything's become mobile, right? Just like when you looked at maybe cloud-focused funds earlier, everything's become cloud. And today there's a lot of AI-focused funds. I believe that, pretty much every software is going to become AI-driven. So the question is, I think you have to make the judgment on whether or not you think a focus fund at that point in time makes sense, even if you know that this trend is going to probably just, encompass the entire market at some point. And then will that team have enduring advantages from having started as a focus fund? And so in the case of an Eniac, we made that judgment that they would, but it's not always clear. It's often, sometimes it's not the case.
That makes a lot of sense. And I kind of want to, as we're inching towards the back half of this conversation, I kind of want to one of the things I've been curious a lot, and I've written blog posts about this, I've talked to people about it, but something I felt like, Aakar, you would be the foremost expert in talking about is the LPAC, the LP Advisory Committee, Limited Partner Advisory Committee. And I know you're no stranger to that, but also, to me, it seems like very much of a mystical beast. They don't operate. There's not as much literature and discourse online about how an LPAC should work, unlike a board of directors and all that. So I'm curious, for you, over the years, you can kind of take this question in whatever direction you want, but what differentiates a good LPAC member versus a great LPAC member?
Yeah, I would say the vast majority of firms have these limited partner advisory boards or committees. Usually they're comprised of the largest or most important LPs. Usually, we're all on these LPACs for the investments that we make. Every one of them, you're right, is structured differently in terms of how often they meet, what rights or what governance responsibilities they have, what input they ask for. So I think being a good LPAC member comes down to a lot of some of the things we've already talked about early in this conversation about going the extra mile for GPs. And a lot of that stuff can happen inside or outside of the LPAC, honestly. I'd say a lot of it, the ways in which you can help a GP, an emerging GP in particular, is outside of the LPAC. But you still want to be a good member. So that means, just some of the simple things like be prepared, show up. You would be surprised how many people don't sometimes, or they send like a junior person in their place.
Yeah.
And, ask questions, bring your expertise, right? Like you have learnings you can draw from a whole roster of other firms in your portfolio, a bunch of other situations that you've been around and seen. And it totally makes sense to use those experiences to, weigh in and be an active LPAC member, whatever that individual LPAC may call for.
What are typical discussion points that a GP may bring to an LPAC?
Again, it can vary. Some can range from like some LPACs we're on, like you have to approve the valuations. every year to, a lot of LPACs maybe just using the LPs that are part of it to get input on challenges they may be having around a team or strategies that they may want to pursue, or if there are certain things that they may have limitations on in the LPA, and they're wondering around, they might have questions around the level of sensitivity that the broader LP base may have around these things. Like when crypto was at its height, that was like a pretty big discussion topic. So there could be it could really range depending on what specific challenges that GP is going through, and especially for younger firms, fundraising and like extending fundraisers and strategy, and that's like also a big area of input for the LPAC. So it's really broad ranging.
Okay. To ask a more pointed question there, and although I know we have a lot of LPs in our audience, I also know we have a fair sum of GPs who are in the audience as well. And I'm asking this question earmarked in 2024 because I see a lot of funds pivoting, like so to speak, like strategy drift, and they want to communicate that to their LPAC. And oftentimes they don't know what the best language is to. Are there best practices around communicating a strategy drift to an LPAC?
I think some GPs don't leverage the LPAC to the extent that they should. Mm-hmm. And I feel like some GPs are kind of like afraid of the LPAC versus, using the LPAC as, because these are your biggest, most important LPs. Yeah. They're on your side. They want to be helpful. They're so invested in your success. And so, I think good GPs really lean into and leverage their LPAC members. And so that's like a difference in approach. And I think the good ones will just be honest about it. Sometimes, again, like I said, these conversations happen outside of the LPAC. Usually LPs don't love strategy drift, right? But sometimes a change in the market calls for it, or, new opportunities that emerge call for it. And those are just like straight up conversations you have to have. But I think when we've seen that, good GPs will have, they'll have a presentation, right, on like, this is what we're seeing. This is why we should pursue this strategy. This is why we're well positioned. Here's what we've done to get up to speed. Are you guys okay with this? And then what are the concerns you have? So that, like, I think it should be really structured and thought through. But definitely, I think GPs should lean into their LPAC on things like that for sure.
So last question before we kind of like go into I call it quick fire round questions, but realistically they're not that quick fire, but it's just like funner questions in general. It's called fun round. We'll call it the fun round. But the last question before we get into that is about that strategy drift for the uninitiated, the untrained ear, the rookies in our audience. Could you elaborate why most LPs or many LPs dislike strategy drift?
Well, you've spent a lot of time getting to know a firm. You've evaluated them based on a stated strategy. You've done your diligence, your reference work on a manager's ability to execute that strategy. Oftentimes that strategy aligns with your thinking. And for a lot of LPs, that strategy may be a piece of a portfolio, that they have a broader strategy around. And so they're looking for managers to fill gaps or targets that they have around a certain strategy. And when you see a firm drifting, a lot of times it's not for the right reasons, right? It's maybe because a part of the market is hot. It's because maybe, they're seeing their peers jump into this category, FOMO that, is often present in our industry. And usually those kinds of pivots don't make a lot of sense. There's a reason why you started the firm and you believed in yourself to focus on a certain strategy. It's a very long-term industry and asset class, right? I think people don't realize that sometimes, but our funds have 10-year lives. They really probably go on for like almost 20 years in practice. You're investing over 3 years. These companies don't mature for like another 6 or 7 at least. So it's hard to kind of ignore the trends because tech in itself moves very quickly, but then paradoxically, the venture industry doesn't in a lot of ways. So you just have to be mindful of that. And we've generally found that strategy drift isn't conducive to good returns. And the other thing we've seen too is like it happens when a firm has maybe raised too much capital, which we saw a lot, 2020, 21, where, strategy drift may mean investing later, investing in other categories to fill up the portfolio. I mean, none of that's conducive to good returns. So I think when there is strategy drift, there has to be a really, really good reason, and you have to be communicating it well. You have to have advantages if you're going to be doing that, and it has to be clear. Otherwise, wait for another fund cycle to implement that change. Because if it's a big enough opportunity that you're thinking about shifting into, that opportunity will still be there 2 or 3 years from now.
The venture game is a long game. It's like 10, 15 years for a fund. If you're doing 3 funds, that's 20, 25 years of a relationship. So the time frames are a bit different than investing in startups. Okay, I promised the fun round. We're going to go into the fun round now.
There we go.
At least it's fun for me. I don't know. Hopefully it's fun for you, but
we'll see.
We'll see. So I'm curious, as someone who helped Fairview get on early in PitchBook in 2011, to spending the whole day in November 2014 playing with the 3D printer at work, to trying the Oculus back in 2014 in its very, very early days, just 2 years after the company was founded, to posting your first Instagram photo just 17 days after Instagram launched in the 2010, you've always been ahead of the technology curve. And so I'm curious, are there any emerging technologies you're exploring or actively using today that LPs may not be aware of?
How did you dig all that stuff up? That is incredible to me. Like,
I went scrolling.
That's incredible. You are probably really great at due diligence. But
I tried. I try.
Okay. So, what are technologies today? Well, obviously AI is a big one, right? I think I have been incorporating like using GPT for memos or synthesizing notes. It's been amazing for productivity. Claude, I think from Anthropic is also great. Sometimes better for certain things, but I think that's pretty much out there. We've also, like firm-wide, one of the things we've done last year was a direct data feed integration with PitchBook, which I'm sure everyone's kind of heard of PitchBook, and maybe we were the first or one of the first fund of funds to do this, but it's been really great. Like we, really enhanced our database, sped up the data collection process, and it's just allowed us to do more things, have better data, and I think as AI becomes more mainstream, there'll be probably ways in which we can use this data to, have advantages in our investment process or sourcing and things like that. And they actually published a case study on Fairview last year. If anyone wants to learn more, it's out there somewhere on this data integration. But yeah, sure. So that's been something interesting we've done from a technology perspective that I think has maybe been unique.
I love it. Still always staying ahead of the curve. I will probably ask you next year, and you'll have another set of things that you're probably experimenting with or using. Okay, so last question. Just be cognizant of time here. So one of my personal favorite movies out there is Pixar's Inside Out. And one of my favorite scenes is when they talk about core memories. So in the theme of core memories, I'm curious, as you one day age and slowly start to lose your memories, what would be the last memory you still hold dear?
The last memory?
I know, it's I'm asking, I'm throwing the hardballs here.
That's a tough one. And personal too. Well, I think this may sound cliche, but I think it has to be, these feelings that you have at big moments in your life. Like the experience of falling in love and getting married, or holding your kids for the first time. I mean, for me, I've gone through these things in like the last 10 years, and they're just so overwhelmingly emotional. It's kind of hard to describe if people haven't gone through these things. And it's just like a incredible part of the human experience that I think those would be the things, those would be the memories that I would hold most dear. I think that's what comes to mind there.
I haven't had the experience of having a kid yet, although I plan to one day. But going back to the big moments in your life, it's almost like a tsunami that engulfs you, that you can't stop. You can't stop the emotions that are flooding out.
Yeah, it's unlike anything I ever experienced in my life, and it's like this moment of tremendous like joy. Uh, like maybe you're scared a little bit, not knowing what to do next. There's a ton of responsibility that comes with it. And now looking back, my kids are 1 and 5 today. Like it's been a really fun ride, and obviously it's had its challenges too. Like the swing of emotions you feel after you have kids is just like so much more dramatic than pre-kids. But at the end of the day, it's been just like a tremendous net positive on my life, and it really just changes your perspective.
I think you're at the days, especially with your younger one, where you might still occasionally be waking up at 3 a.m. in the morning, trying to figure things out, and like, oh my god, it's already been a long work day. I was hoping to get more sleep.
Yeah, as I said, it's a very wild swing of emotions that you go through, and that can happen on a daily basis.
Wow, that is such a roller coaster. You don't need to go to Disneyland anymore. You're at your happiest place in the world. You have it at home, and you also have all the rides there as well. Okay, Aakar, this has been so much fun. I wish we had more time. And I know you're everywhere. You're on LinkedIn, you're on Twitter, you have your email out there as well. But out of all those places, if people wanted to reach out either as an LP or as a GP to pick your brain some more, actually, I hate the word pick your brain, but to like maybe answer some unanswered questions that we've left open from this conversation, how do they best find you?
Yeah, just reach out. We're a pretty open firm. We have an open door policy. You can reach us at fairviewcapital.com. You'll find a connect page, either connect@fairviewcapital.com, or you can email me directly. My email's on our website too.
Amazing. Well, Aakar, this is, man, I wish we had doubled, tripled the amount of time. We might end up needing an episode 2. I have you saw all the questions I was sending you, so we have so many more questions. But I appreciate you, and thank you so much.
Thanks a lot, David. This was fun. Yeah, you really did your homework.
Hello, Superclusters fans. You've seen the logo at the beginning, and now we're here to address the elephant in the room. And the big question is, how intertwined is Superclusters and Alchemist Accelerator? And the truth is, Superclusters and Alchemist Accelerator are 2 completely separate entities, other than the fact that it is only I, David, your host, who is able to traverse between the multiverses. And so the reason Alchemist is a sponsor for Superclusters is the same reason why I ended up joining Alchemist. And it's for 2 reasons: the team and the product. So let me elaborate a little bit. For the team side, I was doing a bunch of diligence, homework, reference checks before I joined Alchemist. And I stumbled across a story which was between Ravi and an early team member of Alchemist. And for the sake of this story, I'm going to call that person John. So Ravi and John were working late at night because they had a deadline coming up. And as they were about to leave, Ravi found out that John didn't have a place to stay and had been sleeping out of his car the entire time. And the next thing Ravi did literally blew my mind, which was Ravi gave the keys to his place to John and said, "John, you're free to stay here for as long as you want." And I knew instantly that this is the team I wanted to join. This is the culture I wanted to be a part of. The second thing is the product itself. Alchemist has built this really robust product called the Vault, and it is the epitome of Peter Drucker's infamous line, which is, "You cannot manage what you don't measure." And so for the uninitiated, what is Alchemist Accelerator? Alchemist Accelerator is your startup accelerator for companies that monetize from enterprises. And so don't take it just from me. We've backed incredible companies, including names you've heard of, LaunchDarkly, Prevacera, MoEngage, and we're also backed by some incredible LPs and investors, including Khosla Ventures, Mayfield, Salesforce. And now, between you and I can't share any of the numbers, and if I do, our compliance officer, will literally gobble me up for breakfast, lunch, afternoon tea, and dinner. And personally, I'm too young to die. But I will say, the numbers, they're great. They're really great. And so if you're curious and want to get involved in Alchemist and the ecosystem, check out alchemistaccelerator.com/superclusters. And that's superclusters with an S at the beginning and the S at the end. And we'll also include these links in the notes. Hey Superclusters fans, this is David from Post and want to share a few things before you go. If you're tuning in from the YouTube universe, and if you like this episode and if you want to see more of it, consider subscribing. It's free. Let us know down in the comments which LPs you'd want to see next or topics you liked and want to hear more of. If you're tuning in from the audio universe on Spotify, Apple Podcasts, or wherever content finds your ear, and you liked what you heard, give us a follow. And lastly, want to share a quick disclaimer from our legal friends. While I am the head of investor relations at Alchemist Accelerator, and that Alchemist Accelerator is one of our proud sponsors, the views expressed in this episode are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of Alchemist Accelerator. None of the views expressed herein constitute legal, investment, business, or tax advice, and any allusions or references to funds or companies are purely for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor near you prior to making any investment decisions. And that's all from me. See you on the next.